Is the Fed one and done? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Brent Donnelly, president of Spectra Markets. Hey, Brent, it's great to have you back on.
Hello, hello. How are you?
I'm doing well. Hi, everyone joining us live on YouTube and Substack. Also, as usual, drop your questions in the chat. We'll get to as many as we can. So we saw the dollar gain a little ground today, but stocks, crypto, gold all retreated a little bit. It seems like everyone's sort of waiting and watching for the Fed meeting this week. What are you expecting around that event?
Yeah, it's a weird one because I think the consensus is very unanimous towards a hawkish cut. So they have the votes to do the cut, but they don't really have a lot of support for like a mega dovish policy stance. So, but then you're getting close enough to May 2026. Like, do we really care what the SEP shows or what they're forecasting when Powell's not going to be running the show pretty soon anyways? Like, obviously there's a few more meetings, but those meetings aren't as crucial as the pricing for the rest of 2026, which is pretty flat now. So like expectations have kind of been pared back in terms of, I think we had this moment a while ago where we were thinking that the new head of the Fed is going to be this crazy like financial repression, cut rates 200 basis points or something like that kind of person. And now even Hassett sounds a little bit more measured. So
Mm.
to me, it's kind of got to a place where there's so many moving parts. And even Hassett said today, it's still going to be data dependent. That new Fed is still going to be data dependent. And then, ironically, as much as Trump wants lower rates, the biggest poison politically is inflation. And inflation's not gone. So if they're cutting, 200 basis points in 2026 into a stronger economy, that's going to be a huge political problem. So I don't think it's really as cut and dried to be dovish later. But for this meeting, it seems very consensus that it will be a hawkish cut, which makes sense. But then I think that's kind of what you're seeing in some of the positioning now, especially in rates, is that people are kind of cleaning up their positions because, I mean, we can get into this after, but there's a lot of things going on internationally that don't really support received rates or long bonds right now. So I
Mm.
think there's a combination of like the global factors and then the fact that we're coming into an FOMC where there's not a lot of cuts to be hoped for in the near term. And so that's why you're seeing a lot of kind of I would say it's more square ups. Like there's not really a lot of fear today. It's more just like a series of square ups.
Yeah, you mentioned the global picture, and it is really important because we don't only have the Fed this week, but we've got so many central banks have decisions and policy meetings coming up as we close out the month. And I know a lot of people have been really focused on Japan. Just walk me through the scenarios and what's most important. Are there any surprises we should expect? I mean, how are you thinking about this?
Yeah, there's a lot of moving parts. I feel, just to start with the BOJ, that the BOJ is a bit of a red herring, I think, because it's basically priced in. And when they do hike, you're still going to have deeply negative real rates there and super aggressive fiscal policy. So to me, like as far as the currency goes, them hiking is kind of meaningless. In
Mm.
fact, there's been other hikes that were similar to this where the market didn't move. Like this time last year, we were in the exact same position. They were priced probably to hike in December. They passed, dollar yen exploded, like the yen weakened, and then they hiked in January and it was meaningless.
Mm.
And I think that's kind of my base case here, is that whether they go now or in January, it's kind of meaningless. I think what's maybe more important is the RBNZ doesn't get like a ton of press, but they are one of the more like tend to be one of the earlier signals in the pro-cyclical economies. Like a lot of times RBNZ or RBNZ will be the first mover, and then Bank of Canada and RBA will tend to follow.
Yeah,
Not
Royal Bank
because
of New Zealand, for those of you
that's
who.
right. That's right. Yeah. Like, so it's not like the Bank of Canada sitting there watching New Zealand to figure out what their policy should be. It's just that there's a third variable, which is global growth, and then the relative setting of interest rates, which tends to be similar, that drives it. And so things are picking up a bit in New Zealand. So the RBNZ was pretty hawkish. Now things seem to be picking up in Canada, if you believe the data, which people can question the data because the standard deviation of the misses on the jobs reports in Canada are kind of egregious. but we've had a bunch in a row. So there is a point where you go like, okay, I guess maybe things aren't as bad. And a lot of it, I think, has to do with the long and variable lags. So Bank of Canada and New Zealand have cut a lot. Like they've cut from above 5 to below like 2.25 or whatever. Those are huge cuts. And they started in July 2024. So yeah, it's basically a year and a half. They've dropped, policy rates 300 basis points or something. So the interesting thing now though is in the curves, if you look at like what's priced into the end of 2026, every single curve in the world basically was just all cuts all the way down. And Bank of Japan was the one exception. And now you actually have hikes priced for Canada, hikes in Australia, hikes in New Zealand. So there's been a pretty big move in global rates. Like there's been a lot of stop outs in Canada specifically, but in global rates, there's been a big move. And so again, it's, there's global inflationary pressures. I understand like there's a lot of deflationary things going on as well, but you have essentially what looks like a reflation trade with commodities doing all right. China exports hit all-time highs, first time over $1 trillion US of exports in 12 months. So as much as there's pockets of weakness in US labor markets, I would say globally, it actually seems like we may have passed the low point for some of those more interest rate sensitive economies like Canada, New Zealand, and Australia, because there's been a lot of rate cuts there. So in the US, that's not the case, but global rates tend to move together. So you're seeing US yields go up today, even though really nothing all that special is going on in the US. It's just people getting ready for the Fed and then people reacting to Canada and other countries.
Yeah, that's super interesting because it did seem like so much of the conversation was about a growth scare in the US and how the Fed was behind the curve.
Mm.
Is that global reflation trade priced into markets? If
Mm.
not, where do you see the most egregious misprice of that?
Yeah, I mean, it's starting to be priced in. Like commodities have moved a lot. The dollar was selling off generally, like was trading a little bit weaker until today. So like in bits and pieces there you've seen it, but I wouldn't say like we're in the middle of a massive global reflation trade at all.
Mm,
I mean, the huge missing piece is energy because normally like whatever if you look at like GSCI commodity index, it has a huge weight to oil. BCom has less, but still a lot of oil. And generally, if commodities are going up, but oil's not moving, those commodity indexes don't really flash a lot of red in terms of inflation. You would need oil to kind of catch up for it to be like a normal reflation trade that we're used to. However, I guess there's a world where you have just a lot of supply of oil from Saudi and from shale and from everywhere. And energy stays cheap while other commodities get expensive. I mean, that's what we've been seeing. I think the vibe now that people are trying to think about is if the oil and gas companies themselves haven't been trading that bad with oil here, that imagine if oil went to 75, how well those stocks would trade. And I think it's partly like not a substitution effect, but it's like if you look at copper or something like that, you say, okay, I don't really want to buy copper here or silver, like they've gone up too much or whatever commodities. So then people start going down the chain and say, okay, well, energy hasn't moved that much. Does AI require crude oil? No, but there's some effect at some point where if you're running out of energy all over the place because of AI, capex, and all that, maybe at some point it does have some marginal impact on natural gas and crude. So I think that's what people are looking at. And it's a time of year when I think it's good to have an open mind and think about like bigger picture things that could be going on, even as I'm a little bit more short term in terms of my trading horizon.
mm.
But this is the time of year I usually try to look out and say, like, okay, what might be some big themes for 2026? And also, even if you zoom in, the big themes of the new year tend to do well from like the 15th of December, because people are trying to front run them and position their books for the new year, till like the end of January. And then the momentum usually fades, and then whatever's going to happen is going to happen. But you can get a good 6 weeks of run on trades. And like we saw that last year with the dollar, with crypto, with XLF. Those were all like the Trump trades. They all ran from the election essentially until like January 28th, basically, or give or take a week. And then all those trades, crapped out after that. So that's a very common pattern that we see. So I'm always trying to figure out like, okay, what are the big trades, just so I can do the Keynesian beauty contest kind of approach.
Yeah, and ride the momentum. We have a question coming in, and we're gonna weave these in throughout because you brought up some really interesting points that I think are worth unpacking. But Rafa saying, "Hey Brent, good to see you on with Maggie. Can you talk a bit about your views on USD versus CNH that you talked about in your recent newsletter, and are you still feeling good about that narrative approach?"
Sure. So just for people that don't follow it, dollar CNH is the offshore version of the yuan. And essentially, it can't trade very far away from the normal like onshore. So when people talk about like CNY, renminbi, CNH, it's all the same thing basically. And there's two components to it. One is, what is the dollar doing broadly? Because the PBOC, the People's Bank of China, manages their currency against a basket of global currencies, and the dollar is a huge part of it. So if the dollar drops 10%, dollar CNH is going to go down just mechanically. That's how it works.
Mm.
But then the other big leg of it is a policy thing. So there's three settings essentially that they can have. Like they can prefer currency weakness, they can prefer stability, or they can prefer strength. And generally, except for one exception in 2015 where they lost control, they've got exactly what they wanted for pretty much 20 years. So they've controlled the currency for 20 years, with one huge shit show in 2015 when they tried to deval. They tried to do like an orderly devaluation, and it became disorderly, but eventually they got control of it. So they've been in a stability regime. So it has felt like dollar CNH is basically pegged, and it's been impossible to trade. It's like trading at three, like depending on where you are on the curve, the vol is like 3%, like annualized in a lot of the options markets. So the view that it's going to move, first of all, requires you to expect a change in policy. And I think it's possible because there's a lot of reasons. One is to make Trump happy, which would be like a nice gesture. But then also corporates are building up a lot of dollar balances in China because of this peg that's been here, and then the massive exports. And at some point, you don't want like to create imbalances. In fact, Macron was talking about that today, that the export imbalances are creating a lot of financial imbalances. It's a way also that they can just kind of signal that if we're in a bipolar world or a multipolar world, they're a serious participant in that. Like if you want to price oil in CNH, or you want to do invoicing with France in CNH or whatever, all that kind of stuff. If you want your currency to be a meaningful settlement and transactional currency, having it gradually strengthen kind of helps that. I think because we've lived through quite a few weakening eras, so for them to strengthen the currency, I think there's a lot of political and economic reasons that it makes sense. And going into a new year again, it's just a bunch of human beings setting policy. And I think a lot of times people tend to have a refresh at the new year and start, even though it's not Chinese New Year, I realize. But and so as a way, so the only reason you would ever do the trade to be short dollars and long China is if you think the dollar is going down anyways, which I do. So then you get a kicker from the policy side. If they say, it would be a headline like gradual weakening of yuan is acceptable or something like that. And then that thing, which usually moves like 0.3% a day, will move 2%. The dollar will drop 2% that day. And so any options that you bought will pay 10 times. It's a really interesting trade in the options market, but I mean, you can only do that if you work at a hedge fund or a bank.
Yeah. But interesting to keep an eye on for the overall China story. Are you bullish China generally, in terms of the economy, or?
Yeah, it's not really a play on the economy. I think it's a little bit outside my wheelhouse, but I think the base case is like secular stagnation, like balance sheet recession, real estate problems, with like sparks of awesomeness wherever the government puts their money, like AI and things
Hand on
like
the
that.
scale. Yeah.
So but generally, to have a view on the currency, you don't really need to have a view on the economy, because they're not like, it's funny because they're very mercantilist, but they haven't really been using the currency as part of that strategy at all for, I mean, really since Trump won. In Trump won, they were weakening the currency aggressively as part of the trade war.
Mm.
But this time, even when Trump was going really wild with like the 297% tariffs or whatever, they actually kept the currency stable. So that was kind of a message that the currency is not going to be part of the game this time. So I would say I'm just like no real view on China as an economy, but I'm just more bullish on the currency.
Yeah. Uh, Great stuff. For those who are wondering about China, we posted for subscribers for the record with Pietro, who has a very contrarian call on China. He's based in Singapore, and he has this sort of regional view on some of the policy changes that are going on rather there. So super interesting. Feel free to post your comments if you disagree, because we certainly know there are lots of people lined up still believe that China has a lot of internal problems. But Pietro's pointing to some policy measures that he thinks are overlooked and underappreciated. So really interesting conversation. So check that out if you get a chance. Question about your outlook for gold and silver over the next 6 to 12 months.
I mean, I prefer silver, but I think based on what's going on, I mean, they'll just keep going up. I mean, there's no serious effort to reduce the deficit. There's not, like, I think people are a little bit concerned about crypto and whether, it's just hasn't really truly revealed, like, is it a risky asset? Is it a safe haven? I mean, it's not, I would say very confidently it's not a safe haven. I mean, it's kind of like a debasement hedge maybe, but I think regardless of what I think the market has now come to the view that it's not for sure that if we continue in this world of, basically financial repression and massive deficits, whether Bitcoin necessarily has to go up at this point, just because there's a lot of separate issues with crypto. So I think silver is the thing that I like the most, especially even short run. Like we got up into the sort of the stratosphere, and then they raised margins on the CME, and it kind of collapsed from like 54 to 46 or something like that. And then now this rebound has been, I think, with a lot less participation than the first rally. So to me, I mean, silver could do something stupid like go to 70 or $80, I think. Gold, I guess, will probably be along for the ride, but I just think silver's the high beta, the way that the two trade.
If we're sort of in a global reflation phase, is that positive for equities or US equities, or is it favor sort of global equities at this point? Do you have a view on that?
Yeah, it's probably sort of like this year where US equities are fine, but if you pick the right countries, you do well. Like people always like bandy around, like Hungary is up 70% if you're a US dollar, whatever. But like there are countries that did worse than the US too. So, but generally, yeah, global reflation should be better for like the value oriented economies and like those kind of equity markets outside of the US. And I guess you have like a margin of safety factor still, even though those things have rallied a lot. And then if energy comes along for the ride, that opens up a lot of different countries than you might have seen this year, because like a lot of energy really hasn't participated as much as like the miners and all that kind of stuff. So the one thing though is there's kind of two regimes in reflation. There's like happy reflation, which is bond yields are going up or sideways in a not too scary way. And then if bond market volatility picks up, like if it's yields up and volatility up in the bond market, then there's a point where that becomes scary, and then that becomes bad. And generally what we do is oscillate between those two during reflation. So I think you have to keep an eye on, like, I just look at move index. It's the simplest way to watch bond volatility. And when that thing starts flying and yields are going up, then that's when I reduce equity exposure, because that's when generally people get scared, and a lot of times there's kind of a delayed reaction.
Yeah. I mean, it certainly was the issue all of this year when yields spiked up, especially if we started to see them go toward 5% on the 10-year. That totally spooked equities. So that
Mhm.
has been consistently a problem. So
Yeah, and it's basically a psychological thing. So like you said, 5% was scary. If it's because of deficits, like that story kind of comes and goes, but if people are worried about deficits or like fiscal issues in Japan or UK or US, those are the three kind of poster children for the deficit story. If people are worried about that, that's another thing where the psychology is different. Like obviously, if we're printing 5% growth and NFP is 120 and break even on NFP is 50K and yields are going up, that's probably good for equities because that's just a good news, good growth. But if yields are spiking on deficits or just because inflation is going up too fast, then I guess that's the watch out, the time to watch out.
yeah, and that inflation story, you're right, there's so much nuance, right? When does it cross over from being good news to scary? And that inflation issue is going to be, I think, a really red hot topic here in the US because I mean, if we had money for every time a politician says affordability now, we are
Mhm.
all going to be tired of hearing that phrase. I think if you're sitting in the US because it's all anyone's talking about.
I know. I think they're playing a dangerous game as politicians to demand lower interest rates because you can do it for a bit, but there's a point where it's going to backfire, and then especially going into midterms, if the inflation is in the headlines and wherever it's coming through, I mean, I don't know. I guess probably it would be electricity prices this time. Like before, it was eggs. It used to be gasoline, but there's always like one or two things that just
Healthcare.
are
They're
or
still
healthcare.
debating the
Yeah.
healthcare premiums, right?
Right, right. So you just need one or two of those things to grab the headlines. And people don't really care about lower interest rates. Everyone's mortgage in the US is still 2.875, just like it was last year.
Yeah.
I mean, I'm not everyone. I realize eventually
No,
they
but
will.
many people are locked in those
Yeah,
longer mortgages,
yeah.
so
Whereas
it's
like,
less of
and
a
even unemployment, it affects 3.5% or now 4.3% of the population, but inflation affects 100% of the population.
mhm.
Whether you're rich or poor. Even rich people are getting annoyed at paying like $38 for a salmon entree delivered by Uber or whatever. Yeah. So I think it's a dangerous game, and we'll see. I mean, inflation is still relatively high compared to target in many countries, like including the US. Like inflation's been above target for 56 months in a row in the US. I mean, to me, that just says they don't have a target. Like the target's 3% now, not 2% probably.
Mm.
But you're coming off a fairly high base after a period of extremely high inflationary psychology, like 3 years of people getting really angry about inflation. So for that to fire up and people to get pissed off again, I don't think will require much inflation this time.
Oh, I don't even yeah, I mean, I think they're already pissed off. I mean, I think
Right,
that you're
right.
seeing that now, right? I think nothing needs to change, and I think that is the sort of the voter psychology and just
Mhm.
consumer psychology, which is super important for the US market. By the way, you were just mentioning rich and poor. I don't know, Brent, if you have had a chance, because it's been so busy with the markets, but, Mike Green has a series of articles on Substack about where the real poverty line is in the US. It's caused created quite a stir. And instead of being $31,000, he argues it's closer to $140,000. Super interesting. I'm going to restack it, folks, on Substack if you haven't. And I'm catching up with Mike on Wednesday. So if you have any thoughts and questions about anything you read in those articles, send them my way. Put a comment in or email me, and I'll be sure to ask him because it's really, really interesting against this backdrop of consumer and voter anger and conversations around affordability. So he did a deep dive on that. Really interesting stuff. Um, Question about I don't know if you're watching the Venezuela situation at all. I mean, aside from a geopolitical point of view, any market implications that you're watching there? That's from
No, I
Andrew.
don't really think so. I think it's more of like an interesting rule of law slash geopolitical thing. But in terms of like oil exports and stuff like that, the market isn't reacting at all to that. So, and we can't trade any bonds or anything like that are all,
Yeah.
impossible to trade. So I would say it's not a factor for global macro.
Yeah. Oracle earnings this week. Been another sort of, spot that kind of spooked the market. People watching for credit distress there. That was a kind of a sentiment changer. Is it going to be important, or given where we are in the year, not so much as last time? And what's your read on that?
I think it could be important because there's a possibility that if they deliver whatever, something like, I'm not going to guess what that would be bullish, but or less bad than people think. But I think there's probably a decent short position in that, because really we started talking about it October 15th. I remember that's when the CDS started moving, and they kind of became like the proxy for short OpenAI because of all the Sam Altman stuff, and people are losing confidence in OpenAI as a business model, because their promises, like they promised to spend money that there's no way they can possibly earn, is kind of the view. And a massive portion of that was promised to Oracle. And so Oracle, when they got promised that, rallied 40%, and then it collapsed and gave everything back and more, because people were like, okay, this is 300 billion written on the back of a napkin. You can't include that in your earnings projection. So I think however they navigate that could be important, because the rest of the AI complex will probably react. Like, I mean, people were trying to short Nvidia, people were trying to short CoreWeave. Today, CoreWeave did a convertible and it bounced all the way back. So it feels like this stuff is resilient. So if we're going to get like another kind of leg of short squeeze slash FOMO slash like AI is not dead, then I think Oracle could trigger it, because that's probably the place to. And like I said, it started October 15th, but then like November 15th, the investment banks were downgrading the debt and stuff like that. So that like Oracle is bad trade has been going on for a long time. And I think it could have some broader market implications if they, I mean, really either way, because if they say, hey, that number was fake, and we were acknowledging that, I mean, that would be bearish. So I think I'll watch it and try to trade some of the proxies.
Yeah. Do you feel like if we do get another sort of scare, or it is a catalyst, does it feel like it's going to bring the whole equity market lower from a sentiment point of view, just spook people? Or does it feel like they're, especially since we've rebounded from those November lows, that we're having more of a rotation conversation right now?
Yeah, so this is not hindsight, because I was saying this at the time, although it was extremely difficult to be bullish when things were collapsing. Like I got stopped out of half of my stuff. But my view at that time, and still is, that it was a rotation basically out of ChatGPT and into other things like Google and things like that. So I don't really think that you can say like, just because, like, if Oracle and OpenAI went bankrupt today, obviously like that would be a massive shock. But like in the broader scheme of things, I think they're just like, they're not really canaries in the coal mine. They're just part of the whole thing. And if those two companies, if like Oracle's not going anywhere, but if OpenAI disappeared, there's 17 other LLMs that will just pick it up and need the inference and need the training and need the chips. And so I don't really think that the entire like stock market relies on the trade.
Mm.
I think what's more important is just the actual capex numbers from the big companies like Amazon and Google and all that, because the economy does rely on that. It just, I think that the question is how long that can keep up, and will it keep up? And so far, I guess it continues to be a thing. And then people are trying to make the arguments of, well, these chips are only going to last 3 years. Are they going to last 5? Are they going to last 10 or whatever? Because it's a different kind of capex, right? Like if optical fiber lasts forever, railroads basically last forever, whatever. Like a lot of the capex that has been the big story in the past is kind of lasts a very long time. Whereas there's an argument about this stuff. But again, I think it's then if people don't like NVIDIA, they'll probably rotate into AMD or into Google or whatever
Yeah.
whoever's the next supplier. So I can see definitely more rotation and scares, but I mean, I don't think on a macro level that, and the thing that will be important on a macro level would be if like a couple of the hyperscalers said, hey, we've spent too much here. We're going to pull back the reins on this AI capex, because then that'll have a massive GDP impact and tertiary impact on hundreds of stocks.
Yeah. Let's end on that seasonal. So you mentioned the fact that, you get this sort of rally on the favored trades or the picks trying to front
Mhm.
run what's going to do well that will last into the first few weeks of the year. Does it seem like there's just momentum for equities here at the end of the year now that we've bounced, whether it's coming from institutions or retail? Because it seems that retail's come in a couple of times this year when there's been a pullback. So does it feel fairly constructive through the end of the year, though, even though people are wringing their hands about it?
I think so. I think until the end of January or so, because the interesting thing with retail is that they've actually got destroyed on the last 2 months or so. Like all the worst things you could buy, like the least profitable, zero revenue, the worst on paper, like Rigetti, Oklo, all those kind of things, like all the things that are like rainbows and lollipops that could work out, but right now have literally no revenue. Those things all collapsed along with all the like crypto dats and all this sort of junkiest stuff was what rallied, and then that all collapsed.
Mm.
So I feel like looking at the real meme kind of retail stuff, it's already been rinsed significantly. And then an interesting aspect in the new year is that the tax cuts that are going to come from the OBBBA or whatever it's called, the Big Beautiful Bill, were not are retroactive to 2025, but they didn't change the withholding. The IRS didn't change the withholding on the W-2s. So people are going to get massive tax refunds in the first, that's usually like Feb 15 to
Mm.
March 30 or whatever. So I think the market will anticipate that. And then also those refunds will probably come into retail. So I think the retail junkie stuff actually might even do okay now, just given the levels that the massive amount of correction that we've seen and all that stuff. So yeah, I'm bullish probably now till like mid-Feb would be my view now, but of course I might change my view at any time.
Yeah, as you should. You're data dependent, just like just
Yeah,
like we
yeah,
all have to
exactly.
be.
I'm vibes dependent.
Awesome stuff. Brent, thanks so much. Bob Fitzwilson says smart man. And yes, he is. So thanks everybody for the great questions. And Tommy Thornton and Blind Squirrel rolling up as well. Appreciate seeing all you guys and gals. Brent, good luck through the end of the year. And if we don't talk to you before then, we will speak to you in 2026.
All right, sounds good.
Thanks,
Happy New
everybody.
Year.
Thanks for joining us. We'll see you again on Monday. Noelle's going to be with us, so we'll dive into both macro and crypto. And of course, it's after the Fed meeting, so there'll be a lot to talk about. So hope to see you then. In the meantime, take care and good luck out there.
Ciao.